Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Saturday, July 22nd, 2023, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, and I am going to be taking a look at this upcoming week. This will be the busiest earnings week of the quarter. I took a look ahead at this week, and I decided that I wanted to play a couple of earnings trades, and so I took a look at what I might be interested in playing, and I came up with 3 plays that we're going to talk about this week. I got an earnings play on Meta, which will be placed on July 26th potentially. And then Chipotle, also July 26th is their earnings announcement. And then lastly, a potential play on July 27th for Roku's earnings. So we're going to dive into those in just a little bit. But before we do that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself and several other Blockhead traders. Love to hear what type of stuff you're trading. Love to hear what type of content you want to hear about. Also, there's a link below to thetagang.com/sprocket888 where I post each and every one of my trades, the good, the bad, and the ugly. Lastly, you can pick up an audio version of this wherever you get your podcasts. And if you can't find us there, let us know and we will make sure we post there. But let's hop to this week's content, and that is earnings trades. And where I want to start before I hop into the 3 earnings plays that I want to bring you is, where do I start when I'm looking for earnings trades? And we've talked about this in past episodes, but you might have missed those, and it never hurts to do a refresher. So let's hop over to my trading platform. I use Thinkorswim, which is by TD Ameritrade, but every platform will have something similar to this. This is my screener specifically for earnings trades. And I got a couple things that I'm looking for here in this. The first parameter that I'm filtering by is the price of the stock. Now, I'm going to trade options, but I care what the price of the underlying stock is, because if it's too low, a lot of times the earnings and volatility just isn't worth it for the premiums. And if it's too high, it sometimes is beyond my position sizing. Now, I don't actually have a cap right now because I'll kind of filter it out as I'm looking through. But most of the time, I am going to look for trades that are going to be less than about $100 to $150 a share of the underlying. If I get above that, that's usually too big for my position sizing, and I'm going to go ahead and have to put some protection legs on that. And actually, one of the picks that I have, 2 of the picks that I have actually are that particular case, where I will not trade them naked. I will actually add protection legs to those. And so we will talk about that. It will be Chipotle and Meta when we get to those. So the next thing I'm looking at is the volatility index. And this is basically the spot volatility of the stock. Now, again, I'm going to be doing the options. This is not the exact same as the options volatility, but it's a good indication. And pretty much I got to put a cutoff around 30%. I've found in my experience much below 30%, and the premium is almost never worth it. A lot of times even 30% isn't really worth it. I really need the spot volatility to be up in the 50 plus a lot of times. But it's a nice place to start, and I'll do additional filtering later. So 30% is my floor, and I don't have a top. As much as volatile as it wants to get is fine by me. All right. The next area is IV percentile, and this is the implied volatility percentile. And so this is always going to be a range between 0 and 100. And this is just of the last year, where is the volatility currently relative to where it has been over the past year. So if you happen to have a 50% IV percentile, what that basically means is half the time in the last year, the volatility was higher, and half the time the volatility was lower. I typically like to see elevated IV percentiles, so usually 40 plus or more. 60 and 70 is kind of a sweet spot, but it's not a hard and fast rule. In fact, you can see right here, I have it open, like wide open, so it's going for 0% implied volatility to 200%. And the reason you'll see is I actually order on IV percentile. So I look at the highest IV percentiles down, and I pretty much just stop looking through the list much below 40. So I could cut this off at 40 and get a smaller list. I opted just to throw them all on there to see what happens. The next one is actually an important one here. It says earnings has. So this is looking for earnings announcement. So basically an earnings announcement anytime in the next 8 bars. And it's set to a daily bar. So that basically means anytime in the next 8 days, do they have an earnings announcement? And this is important because what I want to trade is I want to trade basically the day of earnings. So that is when volatility is going to be abnormally high because there's so much uncertainty surrounding that earnings. As soon as earnings come out, all of that unknown is kind of gone and the volatility rapidly collapses for options that expire the week of earnings. And so I only want to look at companies that have earnings in the next 8 days. And so this is a very important piece of my filter. And then the next important piece of the filter is this average volume. And so I only like to trade underlyings that are very liquid. And I pretty much like 1 million is the cutoff I put, 1 million shares of volume traded daily on average over the past 5 trading days. So this weeds out, abnormal high volume for some small stock that got a bunch of news, memes, something like that. And this is looking for your heavy traded underlyings. And so these are going to be your Googles, your Chipotles, your Meta, your Intel, your McDonald's, your Southwest. And so that's really going to give me the bigger names, which are going to have higher volume. Higher volume means better prices on the more fair prices, I should say, on the options entry. And that's the bid-ask spread will be pretty tight on those. And then lastly, I can tweak this a little bit right now. I'm just looking for not earnings in the next 3 days. And so this is more so I can kind of look out a little bit ahead. Keeping in mind, I wanted to pick something where there's at least some amount of time between when we publish this and the first earnings. So if you happen to be one of those people that pick this up on the day that we release the video, you'll actually have an opportunity to play all 3 of the earnings that we put out here. If I were to pick something that the earnings was the day I released it or too close to that, that's why I put this doesn't have earnings in the next 3 days. So this is really only looking for 3 to 8 days away from today for earnings. All right, so now I go ahead and I run that screener and you can see this list of underlyings here. And what I'm going to do is I'm going to do a quick scan with my eyes from the top of the list down. You can see it's sorted by this column of IV percentile. And so the highest IV percentiles are towards the top, and then they decline as you go down. And so while I'm kind of looking at IV percentile, I'm also going to be glancing over here at both the volatility index. This is the spot volatility of the underlying, and then I'm also going to be glancing at volume. And so there's a couple of things that I'm just kind of processing in my head. One is, do I recognize the name of the underlying? If I don't really recognize it, I'm not likely to trade it. I could in a few cases, but most of the time I'm going to skip over that. And so I'm looking from the first name that I kind of recognize. Here we got Harley Davidson, and I see this is a 67% IV percentile with a 51% volatility index and a 3 million shares of volume. So this is okay. And what I might do is I might go ahead and I click this to send it over to my charts to take a look at the charts here. And so if I flip over and so as I send that over to a chart, I'm going to flip over there and I typically look at the daily chart, and I'm looking for a couple things when I see the daily chart. What is the overall trend at a daily level? So here we got Harley Davidson is kind of increasing. We're kind of coming into a 200-day moving average. That's my red line. It looks pretty, bullish, bit of a trend. It's coming off this 30 low. The next thing I'm going to glance at is I'm going to glance here. And this is a special chart that I came up with. It puts the IV percentile on where is this IV percentile relative to history. And I'm really looking for anything over about 50% IV percent or 50% IV in here. And this is the historical rank. And as long as this is green, that's good. If it's red, typically I might not be taking that trade. So green means you are elevated relative to the historical. And then the last thing I look at is this RSI indicator down here, just to give some kind of just gauge on, hey, where is this as far as the relative strength index goes? And so this is, more on the higher side. So, this is kind of checking out as something I might want to look at. And so the next kind of look, or the next thing I kind of take a peek at, is going to be the option chain window. And the option chain window, this is where the particular pricing is going to come into play. And we're going to see, where does this thing kind of fit? And so I'm going to look at the week of earnings expiration. And so that's going to be the 6 days to expiration. And I'm going to kind of scroll down to see where we're looking. Probably, I would play this on the put side. I probably would not trade this with the call top to it. So I'm going to look here, and likely I'm going to probably say, if I took this at, say, a 30 delta, what are we looking at? And so here I'm seeing, I'm going to collect 75 cents. It's going to go ahead and pull up about a $600 buying power. So looking at this, probably going to collect around 75, 80 cents here for a 30 delta, risking about $600. That's okay, but probably not the risk ratio that I'm really kind of looking for. So from there, I would go back to the original screening window to see what else might turn up as far as that screening. And I'm going to kind of repeat that process, kind of coming down here, looking at, do I recognize the name? Where's the IV percentile? Where's the volume? And I might kind of look through and try to pick out, wow, what's the abnormally high volume? Okay, right here, we got AT&T and Meta. So AT&T is 49 million shares. Meta's 42 million shares. Meta's probably, I mentioned that's going to be one of the ones that I'm going to look at. So let's go ahead and let's pop Meta over and see what I was looking at when I chose Meta. So we got a good 60% IV percentile there. We also have very good volume and a spot volatility of around 55% for the underlying. So let's go ahead and take a look at the chart to see what we got going on with the chart of Meta. And as we switch over to the chart of Meta, you will see an extremely long bullish run here. This is the daily and just a steady march up, 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 up. And we hit a 52-week high here of 318.68, and we've got a couple of red candles coming off here. This is actually something I kind of like to see heading into earnings. Because this means that we are likely on the upper end of a particular range potentially. And so this is usually, there are two conditions where I really don't mind deploying a neutral strategy, a delta neutral strategy. And those are going to be strangles and iron condors. And what that is you basically put a play on the call side and you put a play on the put side. So you're basically playing both sides of that trade. And so I like that when the RSI is pretty close to the middle. I also like that when you have something that has just been running and running and running. You got a ton of call skew to the upside, which is probably what the case is here on Meta, because it's had such a run up. You get lots of people in the calls. The calls have a lot of extra premium in them. And if you're already extended to the ceiling, you have a higher probability that you're going to get some kind of retracement. If you combine that with an earnings announcement where volatility really deflates out of those, you can get a quick turnaround on some of that, as long as you don't punch through that upper side strike. And so as we kind of scroll down to look at the next thing, you can see my custom chart here. We got green. Green is a go. We're on the upper end of that IV percentile, so that's good. Now, RSI, again, it's kind of supporting that on the upper range. In the past 2 days, it's dramatically dropped down almost in the middle of the RSI. So this is something where I would like to consider a delta neutral trade. Now, one of the challenging things with Meta is its price. So $318. Let's hop over to the options window and take a look at some of the pricing there. So as we come over to the option window of Meta, we are going to take a look at where the pricing is. So I'm going to pick the week of expiration. This is going to be that July 28th strikes. And I'm going to go ahead and scroll down here to probably take a look at those 20 deltas is probably where I'm going to try to start. You can see I've actually already got the strikes peeking out down there below where 265 is on the put side. I went a little bit lower than that 20 delta. It's an 18 delta. So let's go ahead and show you what this looks like without the protection legs. So I'm going to go ahead and I'm going to get rid of this underlying trade of the iron condor. And let's say we're going to go straight with the 20 delta. I'm going to go ahead and pick 267.50. You can see right here, the buying power needed for this trade is $3,600. And that's just too big of a position size for me. I like my position sizes 2K or less, but when you're dealing with a $300 underling, that's really just going to be too big. And so what I'm going to go ahead and do, and if we look at the risk profile here, you can see the naked trade gives us this steep curve down as far as infinite loss. Well, not infinite, it will go to zero, but we want to add a protection leg. And the way that we do that is we're going to go ahead and come over here, and I'm just going to step out one notch. Now, you could make this a little bit steeper and step out 2 notches if you want to get a $5 wide. I'm going to go ahead and just take a 250. So I'm going to step out one, which is $2.50 in this particular strike. And that's going to cap my max size at $250. And then right here, you can see my profit is $55 and potential max loss is $195. If I readjust this profit and loss for expectations of standard deviation move, that's what this gray box is. This is the one standard deviation move as predicted by the options chain. And let's go back. So I want to play this delta neutral, which means I want to take on the call side as well. So let's go ahead and we're going to scroll down to the call side, and we're going to look for the similar delta on the call side. So let's go ahead and go with 20. It's really not a 20. So let's go ahead and take 330 here, and we'll step out one and buy the protection on that side. That basically got us the 250 wide condor. So now we've got a 20 delta on both sides. We take a look back at our P&L chart. And we basically now have bumped this up to about $92 on the upside and about $158 on the downside. I like this. This is about a risking 2 to make 1 strategy. It's a pretty good high probability here. You can see the one standard deviation move is within those 2 strikes, and we're only using $250 of buying power. Now, remember, I liked around something less than 2K. So let's go ahead and take this buying power to about $1,500. So to get this to $1,500, we're going to go ahead and need to add some strikes here. So we're only doing 1 contract, but let's go ahead and let's bump that up to 6 contracts. So now we've got 6 contracts on the put side and 6 contracts on the call side. And now we're collecting about $500 and putting a buying power of $1,500 out there. So this is pretty much a perfect setup that I like as far as the ratios go, what it looks like. Now, the reason that I went with a 250 wide condor versus a $5 wide condor or 10 or something like that is I personally find that a $5 wide condor is pretty binary. You're either in or you're out, but you're going to increase kind of that max loss. And when you don't have as much distance or as much fall off on the price for that leg of protection, I like to keep those protection legs really tight together because it kind of mutes the loss. And I'll show you what I mean by that. So if I take these strikes, the protection legs of what I'm buying, and I bump it out to a $5 wide. Okay, so now we've switched it over to that $5 wide. So now you can see we've doubled it. So now we're risking $3,000 here, pulling in about $1,000. So we've kept that ratio. Now, if I wanted to do this contract wise and go back to that 1,500, I'm going to go ahead and need to dial the contracts here back by 50% because I've doubled the width of those. So I'm going to go ahead and pull these into 3 contracts a piece. That's going to keep me at that 1,500. And you can see right here, I'm still at 522. And you can see 522. I flipped this back now to the 250 wide, 6 contracts, and got 550. I'm sticking with this. This is what I like better. So this is the potential meta trade going into there on July 26th, which is Wednesday. It is after the bell. So I will be looking at the same setup on Wednesday during the trading day. And I will be kind of readjusting the strikes. So they're not going to be these same strikes, but I will look for that 20 delta on the put side and 20 delta on the call side. See where it stands up, see where the chart, does it all line up still? If it does, I'll enter these and I'll look to basically ride the earnings out after the bell on Wednesday, and I'll look to close this on Thursday. So the next one up that I want to talk about is Chipotle. So if I come up here, Chipotle is CMG. I'm going to flip over to the Chipotle. This was in the screener. I'm going to skip that step. I'm going to pull up the Chipotle option chain. And before we hop into the option chain, I'm going to flip over to the chart to let you see what I observe on the chart as it comes to Chipotle. Here we go. We got the daily. Now, Chipotle is one of those really expensive underlings. This is, trading at 2.1K, almost $2,200 a share of Chipotle. So there is no way that I'm playing this naked. That's just way too big of a position size. So I'm going to put legs on this trade. And what I really like here is I really like this pop up and then really this plateau that it's kind of sitting on. Indicative of a range, we could crash down, we could go up, could go either way, but I really like where this sits. Again, looking down here, we got green. Green is go. You can see this has not been elevated to this level to call it green for quite some time. And if I come down to the RSI indicator, again, we're really kind of in a trade range of this RSI. And so this looks like a great setup again for another delta neutral trade. And so the thing that we're going to hop over to is we are going to hop over to the option chain, and we're going to see what type of things is going on with the option prices in Chipotle. Oh, switching over to the Chipotle option chain, same thing. We're going to start week of earnings. So these earnings are on 7/26. The ones that expire on 7/28, these are going to be the most volatile. So we're going to come down, and again, we're going to target that 20 delta strike. So right here, we got two 20 deltas. We got a 1960 and a 1955. Let's go ahead and take the 1955. Now, we're going to want to go ahead and put protection on this because you can see this takes $30,000 of buying power. So I don't know about you, but my portfolio is not big enough to handle a $30,000 buying power reduction trade. So that means I got to come out and I'm going to go ahead and buy a protection leg. Now, the interesting thing here with Chipotle is we have $5 wide strikes. So we can't get any tighter than $5. So this is going to consume $500 of buying power to put a spread out here like this. Now, I'm going to go ahead and I'm going to scroll down and I'm going to look for the neutral trade. So I'm going to take the 20 delta on the call side. So here looks like 2270 is the call side. So we're going to go ahead and add a call strike here of 2270. And again, we're going to need to buy protection. So we'll come out one click here for the protection leg, and we will go ahead and buy the 2280. Ooh, notice that. This is $10 wide. This is even wider. So I actually cannot get $5 wide on this. And so if we take a look at the risk profile, look at this. We are lopsided on our call side butterfly. I don't like butterflies that have unequal wings. So in order to do this, I'm going to need to step out another strike on the put side. So if I come down here for that 1955, we're going to need to bump this down to 1945. So we got $10 wide on the bottom, $10 wide on the top. Let's go ahead and take a look at where the standard deviation move is expected. Well within those wings, that is good. So where is this lining up? I want to get at least a third of my buying power collected in premium. So right here, I'm collecting 365 in premium for this with a buying power of 1,000. That's wonderful. That is just above a third. That is exactly what I like to see. And I like to stay below 2K, so I can keep this 1K. I probably could go as big as 2 strikes. Taking 2 strikes there will allow me to collect $730 in premium, risking about $2,000 in buying power. And the standard deviation move is called out there in the middle. So this is, again, an excellent setup. I really like this. We got that green chart saying green is go. We're collecting a third of premium on the buying power that's going to be used for this trade. The $10 wide is very manageable for my position size. And so this, again, is a trade that I'm going to look to on Wednesday. Chipotle reports after the bell on July 26th. And that is the day that I would look, and I would, again, target those 20 delta strikes. Now, some people, when they're doing strangles and condors, those neutral trades, they like to bump out a little bit more to a 16 delta. Sometimes I'll do that if it's more of a naked trade because I might end up owning the shares. But when I'm playing the condors, I'm a little bit, it's kind of binary anyway as you get there to the edges. And so I would rather collect the higher premium. And so I'll pull that into the 20 delta strike. Now, the last underlying that we are going to take a look at today that I'm going to be eyeing for earnings is going to be ROKU. So let's flip over to the chart of ROKU and let's see what we can see on the ROKU chart. Now, the first thing that you are going to notice here when we take a look at it is, okay, it's kind of flat-ish, and it's not a rocket ship up. It's not diving down. We've kind of had this kind of very, very slow march, a little bit upwards, a couple of pops here relatively recently, and the next thing is I kind of scroll down. So, okay, a bullish trade kind of makes sense here. Maybe a strangle, a neutral trade because we're kind of on the upper edge there. Now, one thing I don't like about this trade right now is if we come down to that index that I have going about, is it green? Are we extended from the historical IV? We are not. So the IV, while it is lucrative, is not quite at that range where this is colored in this is colored in green. So I don't like this trade as much as I like the Meta and Chipotle trade. Chipotle was green the longest. Meta was just turning green. This one, we'll see if it kind of flips green as we get closer. I do kind of like the price point of this. So at $69, $70 underlying here, we're really dealing with something that I can trade without those protection legs. And I like that because that really exposes you to the Greeks, and that helps these things move a whole lot faster on earnings announcements. And so we're going to go ahead and take a look at the option chain here to see where does this fit in the scheme of the price points, because it could very well be something that is interesting to trade. So let's hop over to the options chart here. And again, we're going to look for the week of the earnings expiration. That is July 28th. The earnings are July 27th, one day before expiration. We're going to go ahead and look for the 20 delta strike. You can see we got a 22 and a 19. We don't have a 20. I'm going to opt for the more conservative strike here and take the 65, which is the 19 delta strike. And then I'm going to scroll down to look on the call side. On the call side, it looks like we got a 21 and a 19. I'm going to be a little bit more aggressive on the call strike here, and I'm going to sell that 21 delta, which is 85, just because it keeps the numbers nice and even. Not really a better reason for it than that. And you can see we are collecting 265 for a buying power of about $1,600. If we look at the risk profile here and I set the standard deviation move, you can see that our strikes and our break-even points are well within the one standard deviation move. I like on without the protection legs to see more buffer here, this is good. We are basically very safe in a 10% up, 10% move down, looking for that volatility crush. You're going to notice that when you don't have the protection legs, it's harder to get that collecting 1/3 the buying power, because this buying power is assuming and taking into account the potential for assignment here. When you trade without protection, you have to be very okay and good with assignment, because we got a standard deviation move. Many earnings announcements might move 2 standard deviations or 3 standard deviations. because it's really who knows what's going to happen. So it's very likely that you could get assigned, but I really like the way that this is shaped up. It would be nicer to have a little bit more volatility to push that up into the green on the chart. However, I do feel I'm adequately compensated for the risk that I'm taking on this trade. So this is another one that I'm going to look for as we approach Thursday. Again, ROKU is Thursday after the bell. So Thursday day is the time that I'm going to look at this ROKU strangle to see what its price, where is it sitting, does it still look as good as it does today? Hopefully it looks better. If it looks worse, like I said, this is not the most convincing of the three that I put forth. I like Meta, I like Chipotle better, but with earnings trades, you really have to assess it the day of. And that's going to be your personal tolerance. What does it look like to you? How does that trade look? And that brings us to the end of this week's episode. Wanted to visit a couple of earnings trades coming up, as this will be the busiest earnings week in this Q2 earnings season. There's multiple weeks in here, and so I'm going to be looking for earnings trades even beyond this week, but I did want to throw a couple of picks out there for this particular week. Again, we got Meta. That one is a little too big for me to play without protection, so I went ahead and put protection legs on that $2.50 wide iron condor, targeting 20 delta for the strikes that I am selling. Next trade was Chipotle. Chipotle, we couldn't get any smaller than a $10 wide. You could on the put side, you could go down to $5, but the call side was $10. So I extended the put side out $10 because I don't like lopsided wings on my butterfly. Again, targeting those 20 deltas to sell as the short strikes on the put and the call side. And then lastly, ROKU, which is on the 27th of this week. And we are targeting no protection on that. That is a short strangle. And I went with the 20 deltas, or targeted the 20 deltas, ended up flipping to the 19 on the put side and the 21 a little bit more aggressive on the call side. All three of those really matched pretty much everything that I'm looking for in an earnings trade, with the elevated volatility, the volume for liquidity, and the strike premium that we're collecting relative to the buying power risk. Of the three, ROKU was the least attractive, just because that historical volatility wasn't quite in that above 50% range, which is where I like to see it. That increases the probability of a stronger and faster volatility collapse, which is what we're looking for in earnings. In earnings, you want to get extra extended volatility. As soon as the earnings announcement out, you want to see that all evaporate, and you want to close the trade as that volatility collapses, because you've sold that volatility. When it's gone, you can buy it back very cheap. And that is all that I have today. I hope you find a lot of earnings out there this week. Like I said, it is the busiest earnings week of the quarter. So hopefully you can find something that is interesting to you to trade. Earnings are a ton of fun, but they can be very volatile. So make sure you understand the risks that you are taking on. If you don't, I highly recommend that you just do it in a paper trading account, where you're not going to harm any of the capital or wealth building that you have going on in your portfolio. So good luck out there. Hope you find something. And remember, think outside the block.